Hi, and welcome to the Fearless Money Management Podcast, where we empower women to take control of your finances. I'm your host, Claire Strong, and today I'm chatting with Lisa Risser, who's a certified CPA and general financial expert, and we're going to be chatting about understanding your risk tolerance as it relates to investing. Hi, Lisa.
Hi, Claire. How are you?
I am good, and I'm loving our investing series right now because here's the thing. I don't know anything about investing. I don't know the first thing to do as it relates to this topic. So I am in full learning mode here. And today, we touched upon this in our last episode, but today we're really going to take a deep dive into understanding our risk tolerance as it relates to investing. So first of all, let's get into it, Lisa. What should we be considering as it relates to investing, as far as what we're prepared to risk if the investing goes bad?
Well, the first thing we want to do when we're investing is we need to assess our tolerance for risk. And what that means is if the value of your investment drops instead of goes up, how are you going to lose sleep worrying about that? Is it going to devastate you financially? Those types of things. And so there's a process that you do want to go through, because you want to make sure that you are investing in a way that matches your risk tolerance. So if you're very worried about losing any money in any investments, and it's stressing you out a lot and you're losing sleep about it, then you want to invest in areas that are very, very safe.
Okay.
But if you have a higher level of risk tolerance and you feel like you're diversified enough, then you can take some more chances and may get higher, hopefully get higher returns. But if you don't get a higher investment return, you're still going to feel like you're still okay. Then you have a higher level of risk tolerance.
Okay, so let's play devil's advocate. Let's look at both sides, both extremes here. So let's start with we're not risk tolerant. We're the opposite. We're very conservative. We're kind of a little nervous about taking a risk. Maybe we're not very well versed as it comes to when it comes to investing. So what would you suggest to our listeners who, maybe like myself, have not ventured down this path before? We don't necessarily have huge amounts to invest. Where would we start?
Well, if you have a very low level of risk tolerance and you're very uncomfortable investing and you're just starting out and you don't have a lot to invest, it's good to just maybe put it into a high yield savings account or a certificate of deposit, because the returns will be low, but you're guaranteed to get returns. You're never going to lose your money. And it's a good place to start. And
so very low risk baby step for us to take. Okay.
Yeah.
Are there any more that are on that lower risk level?
Well, a government bond would be at that level as well. So those, again, you won't get much of a return, but you're going to get a return. And it's really great when you're starting off, because one of the big pieces is really to have you feel comfortable and confident when you're investing. And if you're just starting out and you're not sure about it, it's a great way to start. Start with whatever you can save and invest, and even if it's $100, then start with $100. Put it into something that's very safe, make you feel comfortable and confident. And it's sort of you crawl, walk, and run type of thing. Like you start crawling and you just do really small and you invest very safe so that you feel comfortable. And then once you feel comfortable and you've saved a little bit, then you might feel like you could venture out into maybe some areas of moderate risk. And that would be, like dividend paying stocks, mutual funds, those types of things that are more of a moderate risk. And that's where a lot of people will end up, is really more in the moderate risk eventually after a while.
I remember actually, I can't exactly pinpoint who it was that they had the dividends with, but my parents, who are very low risk taking people, especially as it relates to anything financial, they put all their savings into this dividend paying stock, and they lost it all, and they were so burnt by that they never invested again. And they'd taken professional advice, and it just didn't work out for them. And so I've always had that memory stored in the back of my mind, but I am a risk taker. So this is good to hear. So we do, if we're low risk, we're looking at government bonds, savings accounts, that type of thing. Moderate risks, just to recap, dividend paying stocks. What about mutual funds?
Mutual funds would be moderate risk as well.
Right.
And the example that you gave of somebody losing everything on a dividend paying stock, part of it too is to diversify.
Yes.
You don't put all of your money into one dividend paying stock.
Okay. And
that's part of the diversification that levels out that risk as well. So you want to diversify. Mutual funds are a great way of doing it because they're investing in different stocks for you. And so they automatically give you some level of diversification. And so it's a moderate risk with some level of diversification that you don't have to think about.
Okay. And just for our listeners and for me too, just explain what a mutual fund is, Lisa.
Well, a mutual fund it's basically something that you can invest in. And what they do is they have a group of stocks in that mutual fund that has some level of diversification. So you only invest in that one fund. They then go and invest in different stocks. And some of them have different purposes. So some mutual funds could be based upon blue chip stocks, for example, which would be the really big companies. Some of them could be, they tell you up front, and you can look at different mutual funds online, and they can tell you what types of funds they are. But you invest just in one fund, and then they go and take your money and invest it in multiple stocks so that you have that level of diversification without even having to think about it.
Okay, got it. So I like the sound of that, actually. I think that's a good middle road. Let's move on to the high risk takers amongst us, which I kind of fall into this category. But what does that look like? Like, what type of investment would be considered really high risk?
So higher risk would be individual stocks. So if you go and invest in one individual stock, that would be higher risk. Cryptocurrencies is a higher risk. Cryptocurrency is very volatile. People make a lot of money and people have lost a lot of money. So if you're going to invest in something like that, that's high risk, like cryptocurrency, you really want to know what you're doing and be very confident in it before you invest in it. People have made a lot of money, but again, they've lost a lot as well. So those are some of the things that would be higher risk. And once you get into moderate risk or high risk category, you can also think about, which I do for myself. So I have a certain percentage of my investment that I want low risk. And that's how you say, I want to be able to feel confident in it and so forth. So it doesn't have to be all or nothing. It doesn't have to be everything's high risk.
Okay.
It can be like I'm a higher risk investor, but I have a certain amount that's low risk. I have a certain percentage that, for me personally, I've identified that moderate risk. And then I have a certain percentage that's high risk. And it helps me to feel like, okay, I feel like I can I feel more confident where I invest in high risk investments because I know that I have a certain percentage that's low risk and moderate risk that makes me feel okay to have a certain amount. And it's not play money, but it's kind of like, okay, I feel okay with higher risk and hopefully get these higher returns. But if I don't, I know that I still have a significant amount invested in low risk and medium risk. So it isn't an all or nothing. You don't just move from one to the other.
Okay.
And everything's, high risk now.
So the key, it sounds like, is to have a balanced portfolio. I think this is a bit of a layman's kind of perspective, I guess, but is it true to say, as it relates to this, that, you don't invest what you wouldn't be comfortable losing? I mean, is that like a good rule of thumb?
Yes.
I don't know. You tell me. Yeah. Okay.
Well, when you're investing in low risk, you're not going to lose your money.
Yeah.
Now, if it's very low risk and the returns are really low and you're only getting 2% returns, but inflation is 5%, for example, in reality, you're kind of losing money because you're not keeping up with inflation.
Got it.
But otherwise, low risk, you don't have to worry about losing your money. Moderate risk, there's possibilities that you could lose money, and hopefully you don't. High risk, again, you just have to be comfortable. And if some people, it doesn't matter how much they have to invest, they're never going to have any of it. It's going to be high risk because they just lose sleep over it. They're stressed about it.
Yeah.
We don't want that to be taking over our lives and constantly worried.
Mm-hmm.
And that's why I like to have percentages. Which, percentage in low, if you get to the high risk category, percentage of low risk, percentage of moderate, percentage of high. Or if you're a moderate risk person, percentage of low risk that you can depend on, and the percentage of moderate risk and that you can feel like you can sleep at night. Like that's I think a big barometer. Can you sleep at night and feel comfortable with how you're investing? And there's different tools that can help you assess that personal risk tolerance.
Oh, great. Well, talk to me a bit about that, because you hit the nail on the head there. We as women, many of us are mums, the last thing we need to be losing sleep over is this. We're losing sleep over our kids and God knows whatever else. So, okay. So talk to me about the tools out there that can help kind of identify our risk tolerance.
There are lots of different tools out there. And I think assessing your risk tolerance is significantly more important than people realize.
Okay.
People a lot of times jump into investing and they don't understand their risk tolerance, and they do things like what you were talking about. They invest in one stock, the stock, maybe that company went bankrupt or something happened. They lost their money and now they're devastated.
Yes.
And a lot of that is because they didn't first assess their level of risk tolerance. So it's something that seems like an extra thing to do, but it's really, really important for you to assess your risk tolerance. And I'll talk about some of the tools. And then once you know your risk tolerance, to invest based upon that tolerance. If you're low risk, then don't invest in high risk. But if you didn't assess your risk tolerance and you jumped right into high risk, you can get yourself in trouble. So it's really important. And there's lots of tools out there. Vanguard has an investor questionnaire, and it really helps you to determine your risk tolerance. They even give you suggestions on diversification and asset allocations based upon how you respond to certain questions related to your level of comfort with risk.
Yeah.
Schwab is another one. They have a great tool that helps you evaluate your risk tolerance. And they ask you questions about your current financial situation, your goals, and again, your comfort with volatility, with, ups and downs in your investments. And then another one to mention is TD Ameritrade. And they have a questionnaire as well. And it focuses on your reactions to different market changes, your financial goals, and then they help you to tailor your investment strategy based upon that. And I really urge people, especially when you're getting started in investing, to really utilize one of these tools and help you to assess what your risk tolerance is And they do also help you to assess, based upon that, here are some suggestions of where to invest your money based upon your responses to these questions.
That's great. So they're definitely worth checking out. And we will, listeners, link all of those in the show notes. So we will absolutely hook you up with the apps that Lisa has just mentioned. But what factors go into risk tolerance then? What categories, if you like, should we be focusing on as it relates to whether we want to invest in something low risk, moderate risk, high risk, or a bit of, all three?
Well, one of them is, what are your financial goals? And are they short-term or long-term? So if your financial goals are to save up for a down payment on a house in the next 2 or 3 years, for example, then your level of risk tolerance will be low because you can't afford to ride out any down market times. But if your investment is retirement and you're 30 and you're investing for your retirement, and that's 30, 40 years out, then you can afford to, because there's always ups and downs in the market.
Mm-hmm.
Then if the market goes down, you can afford time to ride it out and eventually it'll come back up. So your time horizon, how long, what are your short-term and long-term goals is very, very important.
Okay.
Go ahead.
Yeah, I'm just sorry to interrupt, Lisa. But I was going to ask you, what other things? So short-term versus long-term goals.
Yes.
Okay, what other things should we really be taking into consideration before making the leap?
Well, one of them that we've talked about is your emotionally, how do you feel about risk? Are you going to lose sleep at night? Are you going to stress about it? And some people get very, very stressed. And if they do, then you need to have a lower level of risk tolerance. So that's really important for people. The other piece is what's your current financial situation? How stable are you financially? Do you have a stable income? Some professions and some jobs are very stable, and some of them can be very volatile. And if you're in a volatile job and you can't afford to lose your job and you don't have an emergency fund, then you should really have a very low level of risk tolerance. But if you've got a very stable job, you have your emergency fund, you have a low level of debt, and you're very confident, you can afford then to move into higher risk types of investments.
Okay. Got it. So, current financial situation. So, just to recap on that, our income, whether our job's stable or not, whether we have our emergency savings built up, which I know we've mentioned a lot on the show, but you suggest ideally 6 months worth of emergency life savings, and debt level to consider. Okay. Anything else that we should be really focusing on before we make a decision on this?
Well, obviously, if you're younger and you have more time, you can have a higher level of risk. If you're older and you're close to retirement, you should start to pull your risk tolerance down and lower your level of risk tolerance because you don't have the same amount of time. And part of it is just based on your knowledge and your experience. How comfortable are you in your investments? What's your level of knowledge about it, your familiarity with it? If you're just learning and you're starting out and you don't have a lot of knowledge about it, you should probably start with a lower level of risk.
So I have a question. I'm asking for a friend. If you are a woman in your 40s, let's say, who hasn't invested before and is just starting out on her financial freedom journey, what then? Because you're kind of in that awkward situation where you're not in your 20s or early 30s, but you do want to get ahead. And so, is this a prime example of someone who should be diversifying their portfolio and having a bit of everything? Because yes, I want some security in what I'm investing in, but I also want to make some money. So what would you suggest to that type of person?
Well, I think everybody should be diversifying. And then your level of diversification may look a little bit different. So maybe if you're just starting out, you're not really comfortable, but you don't want to be low risk because you don't have the same amount of time as a 20-year-old does.
Yeah.
then maybe you start off with, here's a percentage that will be, I'm going to put in low risk. I need to know that I have a certain amount, my emergency fund and some other savings that I have that's low risk. And then beyond that, I'm going to start to move into medium risk.
Okay.
And then I'm going to start to invest in some individual stocks and some other areas that might be like that medium sort of risk. And then I'll do that. And that would probably be a great place to start then.
Mm-hmm. So we mentioned the apps that are, at our disposal to use. There's lots of help online now, but do you still think there's worthwhile in actually hiring someone to help you? There's hiring a professional, especially if you're moving into that more high risk category where, yes, the rewards are higher, but also the risks are too. Would you advise someone in that situation to maybe consult with an investing expert?
I think that it's always great to consult with an investing expert.
Yeah.
And a lot of times you can have an initial meeting with them and a consultation, and quite often those first consultations will be free, and they will kind of advise you on what their thoughts are. And then you can decide for yourself whether that you want to do it on your own or you want to hire a financial planner. There are a lot of, again, apps that will help you to diversify and to do it that way. And you can kind of do it on your own if you're comfortable doing so. If you're very uncomfortable, it's probably good to just get a financial planner, or if you feel like maybe I just invest a small amount, I'm going to invest it in something that I'm really comfortable with, and just start to go very slowly and then start to learn and go through there. What we don't want is we don't want you to not invest because you're uncomfortable with investing. So if you feel like you're not comfortable in investing on your own, then definitely hire a financial planner to help you. If you want to do it on your own, there are apps that you can use that will help you with that investing. And you can just start off slow if you want to. And do it that way. So it really depends upon your level of tolerance. So the more that you have to invest, if you start to have a significant amount that you're investing, the more that you probably do want to get a certified financial planner to work with you, to help you, to ensure that you have the right level of diversification and that you really are matching that with your level of risk tolerance.
Okay, the other thing to mention as well is the time involved here, because, yes, I may not have the experience necessary or needed to do this on my own, but also, Lisa, I'll be honest, and I'm sure I speak on behalf of a lot of women that are listening to this, I don't have the time. I don't have the time to track this. I don't have the time to put in. So for someone like me, actually, that $500 or however much it's going to cost me to have a consultation with someone is going to be worthwhile. So I guess it depends on your own personal situation too. Are there any no-nos to avoid, like real kind of just don't do this? Do not do this. And especially if you're going out and trying to, get into investing on your own.
Well, I wouldn't invest everything into one particular company or one particular industry. I would not do that at all. You want to invest. And the other piece is I would not, unless you really know what you're doing, and even people who think they know what they're doing still don't do this well, don't day trade, which most women are too busy to be trying to do that anyways. The best thing to do, actually, this helps us with our issue about not having enough time, is that all the experts will tell you, don't just keep selling and buying stocks on your own. Just let it sit there. And I remember, when we had, the Great Recession, for example, and there were a lot of people that they got out of their 401ks and the retirement plans, and they dumped all their stocks and they lost a fortune. But then what happened was, when what came back up, it came roaring back up very quickly, and then they could have made a significant amount of money. So you don't want to get too worried when it goes down a little bit. Eventually it will come back up. And so you don't want to try to time the market, because you're not going to be able to time it. If you think that you're timing it to buy low and sell high, even the experts don't do that so well. So I don't try to time the market. Don't respond to changes in market and just try to say, oh, it's gone down, and now I want to sell it. Those are the times when you're going to probably make the least amount. You've got to be able to sit on your hands and just kind of let this ride most of the time. And if you have a good financial plan that you're working with, they'll help you to do that as well. But if you're doing on your own, try to avoid the urge to constantly be watching that and buying and selling, unless you're like very, very confident. And even people are very confident, usually the experts tell you not to do that.
So would you advise people who might be, have the urge to sell for whatever reason, to, if they are in a position to consult a financial expert before they do that?
Yes.
Yeah, I've actually seen, so I haven't gone along this route yet, but my husband has a lot of stocks, and he has sold stuff in the past. He watches the stock market every day. And if he's seen shares that are, there's something happened in the news, and that company's stock prices has plummeted, or if he's tracking it, and if it's reached a high, he will sell. But then, you know what, Lisa? He always regrets it, because then a couple of weeks later, the stock price has risen again. It's like, well, I should have held out. And so I guess what I'm asking you is, as it relates specifically to stocks, how should we view them? Are we in it for the long haul? Or when is a good time to ever sell them? Because surely we can't just leave them there, forever and ever. We do want to, either pull that money out and put it into something else, or, how long should we be in it as it relates to stocks?
Well, it depends upon what you're investing in.
Okay.
Some people who invested in Amazon or Yahoo many years ago and just let it sit there have done pretty well.
Yeah.
Some of them, if you're seeing an industry that is starting to slow down and getting to the end of their life cycle, a lot of companies, Kodak, for example, there are times when certain types of industries are starting to go on the downturn, then maybe you want to sell them at that point. But doing it on a regular routine basis is usually not advised, unless, like I said, that's really what you want. You feel very comfortable, you do a lot of research, and you're confident in what you're doing, and you have the time. And so, most women, we don't have the time to do that, or frankly, the interest either. We've got other things that we'd rather be doing than just watching the stocks every day. And so it's good for us to just let it quite often sit there, kind of watch it and monitor it. If you have it in mutual funds, they take care of that for you, which is a nice thing with mutual funds, because they take care of it and you don't have to worry about, do I buy or sell or so forth. They'll make those changes for you as necessary.
Something I want to move on to is real estate, because I have a very good friend who is into real estate. She flips properties, so she buys them and sells them, makes a profit. Not always, as she's new to this, so she hasn't. I think she would admit she hasn't made quite the profit that she thought she was going to, but she's learning a lot along the way. Talk to me about real estate, because this is something that you are personally in as well. Yes. Is this something that, if we have the capital to invest, we should be looking at? Because it's something that's always really intrigued me, actually, Lisa.
Well, real estate can be a very good investment, but you have to know what you're doing, and you need to understand the ups and downs of it. You can see all over social media people telling you can, with very little money down, buy rental properties and make a ton of money in a very short amount of time.
Yeah.
And it doesn't quite work like that. So real estate and buying real estate for rental purposes, and if you're flipping,
Yeah.
that's very difficult to do.
Okay.
And again, you have to really, really know what you're doing. And even if you watch like the Home Channel, which I love to watch, and you see those flippers and so forth,
Yeah.
these are experts. And even the experts, and a lot of them are doing even a lot of the work themselves.
Yeah.
You can see that every single time there's something that happens that's totally unexpected that increased the cost way more than they thought it was going to be.
Yeah.
So if you're not an expert in that and you're trying to flip a house, can you imagine how much even more difficult that is? And so you want to have and we'll have a whole podcast about real estate.
Yeah.
But that's one that I think you need to do a lot of research, and you really need to understand all of the pros and cons and ups and downs and so forth in terms of either rental real estate
Mm-hmm.
or in terms of flipping homes. And there's also investment vehicles for real estate. So you can invest in a group that they're investing in real estate, and you don't have to do any of the work, and you don't have to worry about unexpected repairs and maintenance and so forth. And that's, it's called an REIT.
Oh.
And that's another option as well. Now, you might not have the same returns, maybe, that you would have on your own. But maybe you will, because again, and they do take a lot more time. Real estate takes a significantly more amount of time if you're renting them. Even with a property manager, it takes time.
Mm.
And then flipping is an incredible amount of time.
Okay. Well, I would like us to do a deep dive into real estate, because I know it's something that a lot of women, hey, when we're even on social media, it's certainly on my feed, I am inundated with, oh, I've just bought this new house, I'm flipping it. This is what it looked like before. This is what it looks like after. And it looks like these women or these people are making great money and having the time of their life. So I would like for us to dedicate an episode to this and have a realtor on here, or a real estate investment expert, because there is a lot of money to be made, but there are also huge pitfalls. And my friend, who I mentioned earlier, she's told me firsthand, it's extremely stressful as well, especially when you're starting out and you're a novice. And the other thing I just want to touch upon again, cryptocurrency. So again, I think we should have an episode solely on this, because for lots of us who aren't, professionals at this, cryptocurrencies are this kind of like strange out there alien being that we hear of. We're a bit scared of it, and we don't know much about it. So just touch upon that, and if that's something that we are interested in getting into, what are the risks associated with that?
Well, cryptocurrency is definitely high risk.
Yeah.
People have made a lot of money. People have lost a lot of money. And it's an area that you should really understand a lot about it before you invest in it. I have not gone in and done what I feel is enough research for myself to invest in cryptocurrency. I focus on other areas that I feel much more confident, much more knowledgeable about. But people have done really well. But it is one of those ones that's high risk. So you do want to make sure that when you're investing in a high risk, especially, you need to really understand a lot more about what you're investing in.
Well, that's interesting that if that's something that you're not feeling comfortable in, that's a warning, I think, to all of us to make sure that we do feel good about where it is we're putting our money. So, Lisa, anything else that you'd really like our listeners to take away from as it relates to investing and our tolerance for it?
I think we kind of covered most of it.
Yeah.
I think just starting small. Make sure that you assess your risk tolerance, and also that you're comfortable with what you're doing and you're not losing sleep over it.
Yes. Yeah, I think that's great advice, Lisa, because, there is nothing worse than financial stress. And, you'd hate to pile this extra stress upon yourself, especially with all the other things that we as women have to deal with. So thank you
Right.
so much, Lisa. As always, you can check out the Fearless Money Management website. We have resources on there for you. We will link anything that we've discussed today in today's show notes. And this has been great, Lisa. I've learned a lot, so I appreciate that. And if you at home, if you have any feedback you'd like to share on today's topic, how are you investing? What's worked for you? Have you had any nightmares that you'd like to share with us? And what's gone well? What's gone well? Because we're here to celebrate the wins too. So we'd love for you to tell us about that. And that brings us to the end of today's episode of Fearless Money Management. Please don't forget to subscribe, like, and leave a review. Your support helps us to reach even more amazing women on their journey to financial freedom. Bye for now.